Welcome to the Atomic Level, the show where we decode the matters of wealth, one insightful conversation at a time, with the rising stars in finance, business, and tech on Substack, so that you can grow and protect not only your net worth, but also your net happiness. Today, he's not just a rising star, he's a long time followed macro influencer, thought leader in the financial space. He's got one of the fastest growing Substacks, but he's also somewhere in the neighborhood of 60,000 subscribers. So let's get him over the top. If you are new to Michael Green, welcome to the show, Michael. It's a pleasure to have you. I know we've been putting this on the calendar for several weeks. You've had a busy summer.
Yeah, I know it's been a pretty crazy summer for me. I'm working on way too many projects, and glad to take the time to have this conversation, though.
Well, we're certainly honored to have you here. We've had a lot of peers on, some that you spar with, some that you agree with, some that agree with you. Couldn't be more excited to actually have the first person conversation on for our audience and yours today. And so, for those who are not yet familiar with you, I know a lot of your audience knows your story in and out, and there's a lot of those out there. But for those who are new to Michael Green, just give us kind of the man and what shaped his worldview, just so we have context into kind of how you got in the seat that you're in right now and what shaped your views on things.
Well, that's a long, convoluted story. So, I mean, I've been doing this now for, it's kind of crazy to think, 34 years. I graduated from the University of Pennsylvania's Wharton School of Business with a degree in finance and what's called operations research. Initially considered getting my PhD, realized that the analysis that we could do in markets in the early 1990s and the capability to fully understand it was largely limited by the processing capability. And so I transitioned into financial markets in a totally different path. I actually went into strategic management consulting with an emphasis on mergers and acquisitions, as well as divestitures from a corporate strategic planning standpoint. Recognized in the early 1990s that the tools like Excel and discounted cash flow analysis became the mainstays of valuation. Tools were not properly distributed at that time, and the capability to do so was very limited. Along with a couple of guys that I went to school with or worked in consulting with, we launched a software company called Value Add Software that was focused on valuation initially at the corporate strategic planning level. And then one of my mentors, Mitch Julius, reached out in 1996 and said, "Hey, you got this really cool tool. Could you link it to the public equity databases?" We chose to do that. And that actually set the trajectory of my career in financial markets. We sold the company in 1999 to a firm called Holt Value Associates. Holt subsequently was acquired by Credit Suisse. And I transitioned to the asset management side, which is basically my client base at that point. Was somewhat fortunate in that I didn't change. I have a naturally contrarian streak, and so I tend to zig when others zag on a lot of stuff. Recognized that the chaos of the internet bubble was causing valuations to be extraordinarily high. The vast majority of assets at that point were long only, and so I sought out the long only area of the market that I thought was deeply undervalued, small cap value, to a certain extent, mid cap value. Joined one of my clients that focused in those areas, and proceeded to get my teeth kicked in for about 9 months as the mania of the internet, of the .com cycle, played out, and then had a spectacular run from basically March 2020 until give or take really 2006. In 2006, I recognized that the characteristics that had brought me into small cap had actually inverted, that the value space was heavily overvalued. Took advantage of the opportunity to transition to hedge funds. Mitch Julius at Canyon Partners approached me again and said, "Hey, would you like to run our New York office?" Found and run the New York office. I took advantage of that opportunity. Built a team of about 15 people managing about $5 billion as a subset of Canyon Partners, which is a multi-strat based out in Los Angeles. About $25 billion in assets under management at their peak in 2014, when I actually left to go then launch a hedge fund that was seeded by Soros. Scott Bessent was actually the CIO at Soros. That's how I got to know Scott. He approached me and said, "Hey, you want to come work for Soros?" I said, "No, I've got a job." And he had correctly interpreted that I wanted to get back into the entrepreneurial mix. So they seeded a hedge fund. Unfortunately, I ran into a personnel issue. An individual that I had had discussions with previously misrepresented that he had been guaranteed shares in the business. That meant that I got sued at the very start of the launch of that hedge fund. It meant I was unable to raise capital. Ultimately, I won the lawsuit. As my son points out, I spent millions of dollars to defend my good name. And that ultimately, turned out to be totally pointless, other than the fact that I retained all the ownership, won the case, et cetera, but was still out several million dollars in a fundraising opportunity. And then in September of 2015, Scott Bessent resigned as the CIO of Soros, and I, along with basically every outside manager that Scott Bessent had hired, was ceremoniously dumped in what was called the Soros slaughter of the fourth quarter of 2015. Licked my wounds for a couple of months, and it actually, again, turned out to be very fortuitous, as it was the first time I hadn't had risk on in over 16 years. And so I was able to actually spend some time doing some advisory work, doing some consulting, and looking at the market to see what was going on. Fortunately for me, a partner at AQR, Lasse Peterson, published a paper in early 2016 called Sharpening the Arithmetic of Active Management that introduced the idea that this passive phenomenon that had begun to grow in the markets was actually not passive at all. His key insight was that the academic definition of passive investing under Bill Sharpe's 1991 paper, which is kind of the formative component that really kicked off the giant portion of the passive investing boom, was that a passive investor is somebody who always holds every security. They never trade. If they trade, they become active managers. And his key insight was that on index rebalancing, there was a requirement that they actually trade. That meant that they were no longer subject to the Grossman-Stiglitz framework the Bill Sharpe framework that said that active and passive own the same portfolios, and therefore the opportunity set was more robust for active managers around those events. I recognize that every single day these vehicles receive flows from investors, and that raises their cash proportion, requiring them to trade their portfolios on a continuous basis. And it means that they are never passive investors. Instead, what they turn out to be is systematic algorithmic investors. With some of those insights, I went to Peter Thiel, who I had met when I was running my hedge fund. He hired me on to run macro strategies in his personal family office. And we planned and executed a series of trades around this. In particular, the one that became notorious was the Volmageddon events of February 5th, 2018, the implosion of the XIB ETF. Which we took advantage of. We had a sizable trade, did very well on the trade. But that really kickstarted me into basically all, passive analysis almost all the time, right? It created a degree of notoriety and a degree of interest on my part that I really began to dig into this. And so sometime around 2017, actually in advance of that trade, I recognized that the implications of my work were that markets were being heavily distorted by passive investment strategies, and the regulatory framework that had blessed them as uniquely appropriate for U.S. investors. Traveled around the world meeting with the smartest investors that I know, or I knew and know now, and presented my work and said, "Hey, how am I wrong?" And unfortunately, the response was, "I can't figure out why, but it can't possibly be true." We're now a decade into that exploration, and increasingly people accept that my work is somewhat foundational and explanatory around this, and it has continued to power the ability to analyze markets and think about the world that we are seeing in a very, very different way. In 2019, I left Peter Thiel's office. In 2020, Simplify was founded. I officially joined in April of 2021 when we were about $200 million in assets under management. Today, we're around $14 billion, managing strategies across approximately 35 ETFs. And as you mentioned, I, along the way, launched a couple of research firms, a Substack. That's actually an outgrowth from my historical career. I always spent Sundays writing up, or Saturdays or Sundays writing up, what I thought was going on, what was interesting, et cetera, for the team at Canyon Partners, and then ultimately at my own firm, Ice Farm Capital, and what became a broadly distributed email network effectively across Wall Street. At about 30,000 subscribers to my email distribution. Rolled that into Substack as basically a mechanism to continue to publish my thoughts once I had the ability to do so again. When I was working for Peter, obviously everything was confidential. Um, and that has now grown into an audience. It's about 60,000 Substack subscribers. I've had a number of pieces go quote unquote viral over the last year or so. And this Substack is generally, for me, it's a mechanism for exploration. I write for myself largely. I'm writing to explore the content, the concepts or thoughts that I'm thinking about at that day. And that can be everything ranging from a very mechanical exploration of the impact of levered ETFs, which is actually the subject of next week's Substack post. And that it's starting to have pretty meaningful influence. The actual request for this came directly from members of the administration. So I'm increasingly thinking about things that are starting to have an impact, whether that's an analysis of the poverty line and how we're inappropriately defining it and therefore impacting our society, how we've changed tax policy to advantage capital over labor and how that's having predictable effects, the impact of demographics on things like passive flows, et cetera, all areas that are open for exploration. Um, I generally think that, what I bring somewhat uniquely to it, I was actually trained as a scientist very early in my career, considered going into physics. Ultimately decided to switch over to finance because I realized I wasn't a particularly talented physicist, but pretty darn good at math and analysis relative to most people in finance. I like to describe finance as largely filled with nitwits, with the occasional, high level IQ sitting out there that is really a very thoughtful individual. I don't necessarily consider myself to be in that latter category, by the way. I just want to be very clear about that. But I do try to bring a very data driven, empirically focused, theoretical approach to these things. And, so far it's worked and it's resonated. And that kind of brings me up to date.
I think it's a great background for those who know you. That it was a great summary, and for those who don't know you, I think it was a good tee up. You already started to ask one of the questions I've been dying to ask you today, but I'll reframe it and see if I can ask it a different way. One of the things that I love to do is draw potential parallels, seen or unseen. So the passive flow thesis, which you're kind of speaking about, is something that is widely become adopted as why modern markets move the way they do. And like you said, for more than a decade now, it's been something that's been hard to disprove. Want to get into the kind of what would it look like if it was proven wrong in a second, but your career is interesting too. Kind of hearing it through your mouth. How much of your style, just as a working man, right, is kind of trying to see the future and see around corners and position yourself in front of that and professionally? Because you moved into software and you kind of timed that well. You moved into, like, as I listened to some of that story, and then obviously you had, like we all do, you got your teeth kicked in a little bit. You won the fight and you kind of licked your wounds and you got back up and you kind of had that lesson, later on in the career within the last decade. But how much of what you do is kind of by feel or, scientifically, like, calculated, just stylistically? I'm just wondering how, like, predictable, bull you kind of go and how played out in your mind the future looks when you think about where you want to be and what you want to be doing next.
Yeah, I mean, it's interesting. I'll be honest with you, I don't spend that much time actually thinking about the future per se, right? I'm not a futurist. I'm not the sort of person who sits around and says, eventually, we'll all have self-driving cars and we'll, be recreating elements of the fifth element and we'll be flying around, et cetera. I, that actually has very little interest to me. Like it's science, the advancements from science are actually endlessly fascinating. And as a, somebody who is drawn to an engineering mindset, like I'm suitably impressed by all of this stuff, but I also recognize that at the end of the day, my capacity to have an impact in those areas is largely meaningless, and my prognostications about the future are far less informed than many other people are in those areas. But what I'm really good at is actually figuring out when a system is actually mechanical or mathematical in its underlying construction, effectively adopting a near Newtonian type framework that says, look, if a force acts on a particular object, it is going to behave in a particular way given an environment in which it exists. If you push really hard on a rock and you're trying to push uphill, it's going to have a very different effect than if you push very hard on a rock and it's leaning downhill. That sort of capability, for some reason, I seem to be slightly better at it than most people. and maybe it's also just that I'm extraordinarily, um, unwilling to accept the narrative. I see most people offering explanations for behaviors, and I'm just like, guys, that bears almost no resemblance to the actual physical processes that are playing through, and as a result, can't actually be the cause. And the passive investing analysis really drew me in because it was part of the reason why I ultimately decided not to pursue my PhD. Is that once you decide that stocks behave, as if they're incorporating all available information and in a random generalized Brownian motion stochastic framework, they're really not very interesting. And that actually is possibly the most interesting insight I can offer on the whole efficient market hypothesis, which is just it's just stupid and wrong. Um, you know, as early as 1980, Grossman Stiglitz came out with a paper called the theorem of the perfect impossibility, the impossibility of perfectly efficient markets, highlighting that the models of information diffusion that underpin the efficient market hypothesis destroyed the incentives for the actual production of information, and that actually meant that they couldn't possibly be perfectly efficient. And yet, oddly, we have decided to adopt a mechanism for investing for the vast majority of individuals that assumes that that actually is true. And so, the minute somebody actually highlighted one of the mistakes on there, and I wish it had been me much earlier in my career, because maybe I could have had an impact, but the simple reality is nobody wants to hear it. You mentioned today it's broadly accepted. I think that is absolutely wrong. I think that maybe 1% of the financial world accepts the hypothesis and the work that I've done around this. And 99% is unaware, or 98% is unaware, 95% is unaware, and the remaining 4%, the vast majority of people actually strongly disagree with me. And importantly, those who are in the regulatory framework, or candidly in the publicity framework. Robin Wigglesworth at Financial Times just wrote a piece that was largely dismissive of it, even after all of the evidence that is accrued at this point. So I don't, and if it sounds like I care about that, I really don't. I actually, to me, that's kind of exciting. It means that I'm exploring a coastline that almost nobody else has ever been to, and maybe that's part of the allure
Yeah,
as
I
well.
think I'm glad you said that. I think through that lens, it's an important piece of clarity because I made a big assumption there. And the assumption was based on that 100% of the people actually know it exists. And so you just clarified like 95% ish or something don't even know the theory of the thesis exists. And so 1% agrees with you. The other 4% that know are, vehemently opposed. So if they were to steel man, and I mean, from a scientific standpoint, because like the narrative standpoint, like you said, to me, it's not interesting. I think it's creative, but it's not interesting. How do you argue against this? I mean, when you ask the people to disprove it, like when you ask your own question, what if I'm wrong? How am I wrong? Where am I wrong? And it was challenging, and that challenge still remains. I mean, if you were wrong, where would it be?
Um, I think there's a couple of areas and it could be very wrong, but unfortunately, none of those have ultimately played out. Right. The traditional model is that active and passive own the same underlying portfolios, and therefore there's very little impact. And because passive trades, in terms of a native characteristic and very low frequency, the idea is that they have no meaningful impact in markets. For that to be true, the idea of market capitalization weighted portfolios, which to be very clear, I want to emphasize that when I focus on passive, I'm referring to portfolios that try to mimic the broad market. If you send your money to a semiconductor ETF, you are not investing passively. You are making a decision that can have mechanical impacts on the market, but that has very little difference in a fundamental portfolio manager saying, "Hey, I really like semis because it's Tuesday," right? It that is not passive investing. Passive investing is the flow of funds into a total market index, or I will make accessions to an S&P 500 fund that is occurring on a systematic basis through firms like Vanguard or others. That is the vast majority of the passive world. There are levered variants of those that are also passive but have larger impact. ETFs have more impact than mutual funds because of the mechanism in which they're traded and cleared. These are all wrinkles and refinements around that are only interesting if somebody is, as you know, I'm not, really OCD, but I can appear that way when I've got an intellectual problem in front of me.
So, like, I'm going to bring it down, jumping around, because I know you talk a lot about Bitcoin, but I want to talk about this thesis in this framework as it applies to, like, I think it was within the last year. I can't remember if it was 9, 10 months ago, but when MicroStrategy was basically going to lose its listing, right? And regardless of whether people, think that was a conspiracy or a manipulation or whatever, there was a place in time, I think it was about a year ago, where MicroStrategy was about to lose its listing, which would have meant those flows would have no longer been coming into its stock automatically. Bitcoin gets dumped, right? So there was this like
Mhm.
knock-on effect of that Newtonian force, right? Someone applied pressure against a flow mechanism, and there was this impact. How much of that was narrative versus scientific? Like, how much of your thesis predicts something like that versus or proves something like that
Well,
versus
what I would never try to do is predict that MicroStrategy is going to be delisted. That's the province of somebody else. But what I can do is I can tell you the impact that MicroStrategy's flows and broader ETF flows have on Bitcoin itself. And there's nothing magical about Bitcoin. It's just a highly inelastic asset, meaning that flows in and out of it because of a limited supply framework. You always have to find somebody who's willing to sell you basically their own Bitcoin. The Bitcoin world, at least historically, had been heavily populated by true believers who are unwilling to sell their Bitcoin. And as a result, the price of Bitcoin rises as more people hear about it and decide that they wanted to buy it. Now, of course, the narrative becomes self reinforcing. The rising price of Bitcoin then creates demand and interest in Bitcoin, and it creates a classic Ponzi like characteristic that's ultimately quite uninteresting, except for all the ridiculous commentary around it that suggests that it's going to become the new form of money or that it somehow magically solves financial systems, et cetera. And candidly, I'm extraordinarily disappointed with many of my peers who have abandoned any precept of logic in pursuit of it. The profits associated with it, there's a genuine disservice that is being done to the investment public in the current world, and I think it's really unfortunate that people who should know better and should be able to take a very calculated approach to the actual underlying thesis behind Bitcoin have just completely whiffed it. And that's not me being salty. That is literally me looking at the mechanics of the system. I've written about this extensively, and broadly, I'm just done with Bitcoin. I think it's incredibly boring discussion.
so the piece that maybe you're also getting bored with, but maybe not, would be the AI trade. Where do you sit on what's interesting about that and what's not? Specifically, what's interesting about it from your framework standpoint, because there's a lot of places in that layered stack
Mm.
where value is going to accumulate or dissipate. We just saw Kimmy K3 drop and a whole bunch of stuff happened, right? But talk to me about what's interesting for you in that realm.
Well, AI is actually quite radically different because it is an expansion of under its uh, best framework. It's an extraordinary expansion of human capabilities on par with the introduction of the written word, which radically increased our ability to memorize as a society and retain knowledge in a manner that had never been created before. When you run an oral society, if the storyteller gets eaten by a saber-toothed tiger, that knowledge is lost. If it's printed on the written page and people are literate, they are able to carry knowledge across time and compound it in a way that can't be done in an oral history. Imagine trying to read the Library of Congress, how long that would actually take. It simply can't be done, nor can it even be remotely memorized. And so, writing is one of these inventions that actually expands the capacity for humans to retain knowledge and share it, distribute it. And that is ultimately what creates wealth. I compare it to eyeglasses, which took a giant fraction of our population and suddenly made them viable members of society at radically lower cost than would otherwise have existed. If you were extremely nearsighted in Paleolithic times, you got eaten by a saber-toothed tiger unless the tribe protected you and put you in the center of the universe. Um, if that happened to be the smartest person, that was an incredible loss to that tribe. The introduction of eyeglasses changed that radically and increased the number of people who were able to become educated, who were able to participate in society. Likewise, the introduction of antibiotics radically changed society by ending largely the random deaths that would occur if you cut yourself while shaving prior to about 1940. These are all extraordinary inventions. Transport, railroads, boats, etc., expanded our capability. Nobody can swim across an ocean, but guess what a boat can do? It can travel across an ocean and provide you with far more resources than you had before. Um, AI is the same thing. It takes people's intelligence and it potentially magnifies it. Now, that can be used for good purposes. It can expand the capability of every member of our society so that we stop fixating on stupid stuff like, is my IQ 85 or is my IQ 115? And instead has the potential effect of raising everybody's IQ to 250. That would be an extraordinary expansion of human capabilities that would have profound implications. Candidly, I can't approach because I'm just not that smart. At some point, you stop having conversations with people. Most people suggest that somewhere around 3 standard deviations of IQ makes you completely unintelligible to the vast majority of people. I may be pushing that for some of my audience, which is not to highlight that I'm that smart. I'm just saying like the spread is pretty big, and so this is a reality. We have to consider that AI enhanced human beings will have radically different capabilities, radically different thought properties, radically different motivations in many ways than humans without that access. And so I think this is one of the most profound inventions that has ever occurred. How it plays out is going to depend on how we build the regulatory framework around it. And that's actually quite interesting to me right now. And how we choose to build the capital structure around it also really, really is going to matter.
Yeah, I think those two things are. I want to hear what your thoughts are on that, because I think the capital structure. I've written about this. I know other people have written extensively about it on Substack. The capital structure is, like always, in my opinion, pretty broken. Typically gets that way. We had it with dark fiber and the double O's. We had it with .coms prior to that. Like, we get ahead of ourselves, right? The inevitability of it is also, again, just my opinion. Indisputable. Like, we're not putting this back in the bag at this point, right? So, where do we end up? Probably somewhere we can't even imagine today, because none of us are that smart, and the handful that are building this stuff, and they don't even know. But how we get there and how lumpy that is in markets or in opportunities or in jobs or in different things, that's kind of interesting. So I'm curious as to what you think is good about the current capital structures, where you think, other than the obvious stuff, where you think there's some gaps or risk. And then regulatory wise, in an arms race of this magnitude, where individual, but also, country sovereignty is literally the stake. Like, how do you regulate? How do you slow down something that, if you get left behind, you may never catch up? I mean, that's I think the interesting conundrum that we're in. So I'm curious as to your thoughts on that and some of the conversations you've had around those things.
Yeah, I mean, so the quick answer is, one, I'm not sure that you actually can regulate it to slow it down. No matter how smart the regulators are, an AI assisted individual is always going to be smarter. What I think we have to be very careful of has been largely thought through in the science fiction space. If you think about the 3 laws of robotics from Isaac Asimov, we've already thought through some of the philosophical components to it. What would be really terrifying is if somebody misspecified an AI as not a tool for humans to use, but instead a self-advancing tool that had to take its own self-interest at heart. Now, that may be an emergent property of the system. I don't know. I genuinely don't know. My hunch is that the emergent properties, if they exist, will largely be introduced by human programming errors. And we have to be very, very thoughtful about that, right? Effectively, at its core, I would encourage us to think very seriously about introducing something like the 3 rules of robotics, ultimately saying nothing can be done to harm human beings. But of course, that's a completely absurd introduction in a world in which there is global political conflict between 2 very, very different frameworks in the United States and China. Although the two are merging in many ways, with the United States becoming more and more like China, and ultimately its suppression of the broader population in the interests of the elite. That's really what a technocratic environment is, which is really what underpins all socialist or communist systems. Is the belief system that, if you went to the right college and you grew up in the right environment and you know the right things, then you are uniquely qualified to guide human society relative to everybody else. I think that's just incredibly stupid. We exist as a social species because of the benefits of networking. Claude Shannon taught us the laws associated with that. The more nodes in a network, the more valuable the network actually is. There's not a refinement of that for the quality of the nodes. It's actually all the nodes in totality that ultimately determine the characteristics of the network and its capabilities. This is why a mesh network, for example, is very robust, even if individual components to it are quite weak. It's a reinforcing component. Capitalism is that social network and that framework in which everybody pursues their own self-interest. And as a result, the collective ends up far better off because we can share that knowledge. Knowledge is largely non-rivalrous in its components. Historically, when we've tried to restrict that knowledge, i.e., it will be held only by the priests, or it will be held only by men, or it will be held only by a certain social class, those societies have stagnated and fallen behind societies that didn't place those artificial limits. And I am very worried that we are in the process of doing that we are slowly deciding that people at a certain level are capable and deserving of these skills and capabilities. And we are largely determining that retroactively on the basis of their individual wealth. It should be a warning point for everybody that, children are born with no wealth. They receive access to their parents' wealth, but there's nothing about those capabilities that ultimately emerge. I was born into a relatively poor family. There's nothing about those capabilities that emerge that is tied to a genetic endowment in any meaningful way when we're talking about wealth and access to education and clean water and everything else. Yes, very smart people tend to have higher incomes. That is because they have more access to more opportunities because of their intelligence, and that's absolutely true. But the formation of that intelligence, is things like the Flynn effect would argue, are largely a byproduct of the experiences and opportunities that you're exposed to. While I was born into a relatively, not wealthy family, we were, farm. I grew up on a small farm. My parents had a strong and abiding respect for education and made extraordinary sacrifices to provide me with access to education that allowed me to build the capabilities that I now exploit today. Many children grow up without that access. That's what we tried to solve with universal public education. We largely screwed it up, turned it into a jobs and daycare program. And we no longer seem to understand why we are doing many of the things that we're doing. That's part of the reason I've become such a passionate, speaker on social issues, because I just think we've completely lost the plot. And I think, unfortunately, the discussion around AI is one that could cause that to go even more deeply off the rails.
Yeah, I for probably different and similar reasons, I tend to agree with you on that. I think, we spent 100 years training everybody to get the right answer, and now we don't need to do that anymore, but we forgot how to ask good questions. And I think that's what I love about this kind of format, or even Substack kind of having a moment. And again, it's just another platform, but the I think the intent-based search and the long form content gap is being filled because people are trying to figure out, what questions should I even be asking? So what questions are you asking yourself around this as it relates to your own use, as it relates to your own business or your own family? Like what kind of things are you thinking about as it relates to practical, how am I going to approach this abundant intelligence opportunity?
Well, the quick answer is that there's a nearly unlimited number of components, right? I mean, if I have Claude running in the background as we're discussing this. I'm looking at the history of my chats, right? Recent chats, leverage ETFs during market corrections, migrating to Linux as a financial analyst, the affordability crisis explained, it's literally just me reading them down, right? Academic validation of a decade of work, Python passive signal extraction. Here's the underlying data on something, ETF asset class allocation, right? My brain is all over the place, but it is largely focused around financial markets and exploring these components. I do think that there's an extraordinary opportunity that's emerging for me as an individual at this point, The growth of passive investing, which has gotten to 55% market share by my calculation, has largely um, allowed Vanguard and BlackRock to capture the regulatory environment, create conditions under which the rest of the industry is shrinking. And candidly, I will chastise the rest of my peers as saying, you are largely cowards who have retreated in the face of that onslaught and not tried to figure out what was largely going on. You basically doubled down into doing the exact same thing that you've done historically without appreciating that the environment has changed. It's like positioning yourself to run uphill when you're actually running downhill. It's just a stupid approach.
Mhm.
Do I think this will maintain itself forever? No, I actually am quite hopeful that something else will emerge. But in the current environment, people have largely abandoned the center of the portfolio. Roughly 70% of US financial assets are allocated to equity markets. About 94% of that is now allocated to the S&P 500. And by and large, my entire industry has stepped away from allocating assets to core equities on an active basis because they've gotten their teeth kicked in over and over and over and over again. And I would argue again that is largely because they are using archaic approaches in an environment that has been changed by regulatory frameworks and the mechanical properties of the systems that we're building. I think the opportunity to go after that center of the portfolio is reopening. And so I'm spending the vast majority of my time actually thinking about ways to do that and building the infrastructure and resources and capability to do so. And if I end up being right, that would be fantastic. I actually think that it would be obviously it would be a huge benefit to my personal wealth, but far more importantly, it would help a lot of people in their portfolio construction, both in terms of protection from the downside and the ability to participate on the upside. We'll see if that ends up working out, but I'm very close to making some announcements around that. And that is the primary focus of what I'm doing right now. It's part of the reason why I've got bags under my eyes and, everything else. But that it's also because I'm, 56 years old. But the the key point that I would emphasize is that the vast majority of people in my industry have at this point just folded their cards and said, I'm not really going to play. I'm just going to, participate, right? Almost like the complaint against the millennials has now largely lodged itself. And we see this in the underlying data. The framework is extraordinarily robust. That we are seeing more and more active managers basically turn into closet indexers in an attempt to not lift their head up high enough to get shot over the trench. Um, Again, that's just not how I operate. And it makes me simultaneously appear like an arrogant asshole, which I very well might be, and also somewhat of a passionate advocate for a world that could be very different than the one we currently inhabit.
I mean, I don't know you that well, so I can't speak to the arrogant side. I don't see it that way. I see it as a guy who just needs to be interested in what he's doing. I mean, like, let's be honest. Like, I mean, I've made a lot of mistakes being interested and curious because I just can't help myself from trying to figure something out, even if I should just be over here riding the passive wave, right? I'm just built a certain way. And I think recognizing how you're built's important for anybody listening to this. You're recognizing that you're built to do stuff. Like, you're not built to just allocate and aggregate. And that has become the industry, and it is what it is, right? Um, I want to weave a couple questions together so you can just go on a rant here. But I want to shout out to
The
Tony.
entire thing has been a rant, Chris. Let's be honest about it. But
How
okay.
we roll with the atomic level. So, all right. So Tony Rehan, I want to give you a shout out. So he's I'm going to weave his together with a couple of other follow-ons. So one of the things that you just mentioned there was kind of this. I'll just call it a pendulum. Maybe that's not the right analogy, but this swing into kind of uh, where the allocations have been and what the managers have done. The fact that there's no ROI and no right. So just keep my head down and just keep doing it and hope the phone doesn't ring with my book. Um, but Tony said, what could trigger a passive investment market crash? So that was his question. But I'm going to frame it in a couple different ways. One would be, is that required for that kind of core middle of the portfolio to kind of have its moment, whether that's in alts taking up 18 to 20%, or is that going to be an off ramp to something like that that gets kind of promoted and pushed and recommended? What do you think about fee compression, if that's even something that you're looking at in the regards of this world that could emerge on the other side of this kind of gravy train, maybe having a rough patch? Run in any direction that makes sense, but I want you to build on kind of the thesis behind what you're building. It sounds like you can't announce it yet because you're going to be announcing it soon. So everybody that's not subscribed to him, make sure you follow him on Substack, subscribe to him, get on his website, whatever it is, so that you don't miss that out. But if you can't announce specifics, what's the thesis driving what you're working on right now? Because obviously you're working hard on it from what you just said.
Yeah. I mean, very quickly, the underlying thesis is pretty straightforward, which is that there are opportunities to be passive. Those who follow my Substack know a lot of the work that I've been pushing in this area, that ultimately by um, Vanguard and BlackRock and passive strategies have become so large that many aspects of their behaviors have become increasingly predictable. That allows you to, for lack of a better term, effectively front run much of their order demand. That is, again, I hate the use of that term because that's not what we're actually doing. We don't have it like insiders at Vanguard are like, hey, we're going to buy. But we are using tools to effectively mechanically source out that bid and understand how that impacts each individual stock. I'll be totally candid. You talk about the arrogance. There is an element of the success that I had around the events of Volmageddon that I think took me on a meaningful mistake and detour for an extended period of time on this. If you just mechanically think about passive behaviors and in general, the behaviors around gathering assets, it's like collecting water into a fire hose that then directs liquidity at that portfolio. If everybody decides that they're going to invest in the exact same portfolio because it's called the S&P 500, and you are driving that flow, you need to think not necessarily about the flow itself and much more about the impact that it has on each individual security. And so imagine it like a fire hose in crowd control. Some people are going to be affected by it much more than other people. It's not just going to be a function of size. I'm a relatively big guy, although significantly smaller than I used to be. And if I'm hit by a stream of water, it's going to have a very different impact than if my wife's mother is hit. She's, 5'1", 5 feet tall, and, it'll just immediately knock her over. However, if I'm bending over to help her and I get hit by that same flow of water, I also am going to fall over. And so understanding those components is really critical. Where I got spoiled was because the XIV or the volatility complex was a single security. It actually was far more predictable at the index level than the components of the S&P 500 are. And so that has really been part of the breakthrough that has been powering my recent work over the last year is basically taking that flow, disaggregating it, looking at the impact that it has on each individual security, and then separating those out into portfolio construction techniques. I first introduced it to some of the tools that I use around hedging with very good success, even though the environment was very rough for those hedges. But at the same time, it's now turning into mechanisms that allow me to recreate exposures to U.S. large cap equities with very low tracking error, which is critical in the institutional space, and yet generating significant excess performance that is starting to attract some interest. And that type of capability, to my knowledge, nobody else is doing it yet.
So
I am. I'm not misleading myself. There'll be fast followers, by the way.
yeah. Well, you kind of hit on this a little bit, but just to weave these two, so I can make it ask, why is a passive flow not a rising tide for all? Speak.
Well, so let me give actually just a couple of really quick examples. Imagine a scenario in which 99% of the index is in a single stock, and there's 499 stocks that are 1% of the index. We can call this place Korea, for example.
Mhm.
Um, the reality is that index flows at that point would only be really relevant for the one stock. They would be diluted to such an extent for all the other stocks that it really wouldn't matter. This is one of the reasons I emphasize that market cap weighting is what I think of as passive. If I build a random portfolio, like think about the XLE within the sector funds. Due to modified cap weighting, you basically have Chevron and Exxon are the only two stocks that matter in those indices. So I look at some real estate indices, none of which attract significant flows, to be very clear on this. You will have a single security that is massively overweighted relative to its market cap due to the characteristics of float adjusted weighting or modified cap weighting adjustments, or simply the desire to obtain diversification. The SOX index, the semiconductor index, which was introduced long before the idea of broad index exposure and was not a tradable product really until after the 2008 events. would be another great example of a product that is not at all cap weighted, but is now having an extraordinary impact on individual securities because of flows that are being directed at various trading vehicles around that. That's actually what I'm working on right now. And it's super interesting to actually be able to disaggregate this, but it perversely requires you to be able to think in a strange space. I basically have created agent-based models. People have heard me talk about this many times, but each individual security becomes an agent. That agent then receives flows from other players and is cross impacted by flows into other components. If NVIDIA becomes a larger portion of the market cap of an index, it's going to receive more flows than a company that becomes a smaller portion of the index, right? So there's feedback loops associated with all of this sort of stuff. And it is a complex math problem. I mean, it's really nothing else. It's just a math problem. Um, and as I said, I tend to be pretty good at those things, but certainly not uniquely qualified. Put me in a room with
Yeah.
Terence Tindall, and there's exactly one great mathematician in the room.
Does that become a layer unique to the simplified packaged products of ETFs and things like that moving forward, or is that a licensed API that other ETFs will use?
Well, it becomes both, and it actually goes to the point that you were highlighting, or the question you were highlighting around the components of fee compression, right? The simple reality is that the negative associated with the pressure that Vanguard has put on costs is that there's very little money available for research. That was temporarily ameliorated by the shift to higher fee entities like hedge funds, which I took advantage of and I appreciate very much. But at the same time, the aggregate fees within the industry have compressed radically. And today, the only real fees that are being charged are for access to levered ETFs, which have all sorts of weird mechanical components to them, as we've been discussing. But you're basically paying at that point for access to leverage. And it's kind of a, it's unfortunate that our regulators are largely blind to the implications of many of these strategies. Um, that required me when I joined Simplify to launch a research firm associated with that, that's Tier 1 Alpha, that largely supports my unending research habit and expenses. We spend an extraordinary amount relative to our revenues on data and programming capabilities, and I'm blessed to have some really talented programming partners there. But the actual ability to do research within an ETF firm, unless you obtain additional sources of financing and funding, doesn't really exist.
And
It's not enough.
I think what I'm most bullish about with regards to advisory firms or research firms with AI is, the use of what I call a system of intelligence, a private AI layer on top of open weights, frontier stacks, whatever combination or system of record you may have, where this kind of codified knowledge graph can be part of your enterprise value, which is kind of what you're speaking to, is your ability to take this big investment, call it, as a percentage of revenue, and bring in data sources, but now create maybe a proprietary knowledge way of thinking, testing, challenging your assumptions using your own AI to then spit out more or higher volume of quality research than you would have been able to with that same revenue line, right? Is that kind of where your head's at as
Yeah,
far as
look, I think research has a lot in common with things like programming. You'll see you'll see the analysis every once in a while that people running tech firms will say one really good programmer is worth 100 mediocre programmers. I think that's absolutely true in research, and it's part of what I would emphasize around AI. Is anytime you hire an analyst, you now have to deal with not only your interests but also the interest of the analyst. The analyst wants to make sure that they're recognized for their good work. They want to make sure their ideas get into the portfolio. They want to make sure that their viewpoint and their moral sentiments are expressed in one form or another. And candidly, finance has largely papered that over by paying people an extraordinary amount of money to shut up and do what they're told. It's one of the reasons why my daughter, who works in financial services, is looking at the environment and saying, yeah, I mean, why raise my voice? Why do anything, et cetera, other than do the work because it compensates you extraordinarily well. And I think that's a positive attribute in many ways. But when you start shrinking that compensation, you actually find that the other components of it begin growing in relative importance. And now suddenly you no longer have the funds to attract really talented people unless you happen to be on a slightly different angle of the business. And I've started to write about this as well, where there's still largely unlimited resources in the market making and facilitation side of the market as compared to the corrector or contrarian component that ultimately is represented by a value manager whose objective is to say, hey, you did your analysis wrong, right? You know, there's been an unbelievable degradation of people's willingness to actually think differently in this business. And it is understandable because every time they pick their head up, they get hit in the face. Um,
It's interesting because I think about that too. I think don't know enough to say this with any certainty, but I'm gonna say it like I'm certain, just for you to react to, right? But
yeah.
I think there's been kind of like a great homogenization in society at large over the last 20 years, right? Of Web 2, call it the social mobile web, because the algorithms essentially rewarded you to be like your peer set. And so the validation, the cheap dopamine, all those mechanisms that we see play out in everything from fashion to, the way we date to whatever kind of compounded. And I think in finance, similarly, right? Passive, you could make a very loose general argument that kind of happened too, right? Just allocate here and, you know, take the fees and keep your head down type of thing. And so being different was not rewarded. And then access to intelligence that could make you different was hard to get. It was still very pricey. As we think about the world where intelligence is now being commoditized and where we've kind of gone through that sway of homogenization, I could argue, not very well maybe, but if I wanted to, I could argue that we're going to go into this kind of defragmentation, like this decentralized intelligence world of ideas where the markets could actually get very volatile, very interesting. The arbitrage could increase, not decrease. Because one of the arguments I've heard is AI is going to remove all the arbitrage because everyone's going to have the same tool. I might argue that the arbitrage will increase simply because there'll be more ideas floating around and more bets on the table that are different from each other. But I don't know which one of those is likely to play out.
I think again, it depends on the rules, right? Imagine a society, Handmaid's Tale is a great example where, physical punishment is reintroduced for deviant behavior in an extreme form. And deviant behavior could consist of smiling at a boy who's not allocated to you, right? It, it, we as a society have become extraordinarily tolerant of ridiculously bad social behaviors, in part because we no longer define ourselves as members of broader society. I don't live in Annapolis. I live online, right? I don't live in, the community that everybody physically occupies. I'm completely distracted when I'm sitting at a bar. I'm scrolling through Facebook or Instagram or Twitter or whatever, because I really live online with these people. They get me. They're my friends, right? That's all crap. And it is part of the reason why we need to fully understand that we are increasingly, actually, I would argue fracturing around social beliefs, even as we become more homogenous in our underlying behaviors, right? We all drink Coke or Diet Coke, and, there are no regional soda brands anymore and very few regional food types that people are enjoying. I can get Detroit pizza just as easily in San Francisco as I can in Miami as I can in Detroit. That's a remarkably uninteresting world in many ways. And it's one that I hope actually changes and reintroduces the social cohesion. It requires people to acknowledge our behaviors in public, largely define how well we can get along, and putting emphasis on geographic proximity as compared to speed of communication. That is one of the radical things that has changed over the past, give or take 30, 40 years, is the communications revolution that can allow me to instantly talk with people in Singapore and London at the same basic cost that I talk to people who are next door. In fact, it's actually cheaper because I don't have to get out of my seat and move my fat ass to go ring their doorbell to talk to them. And we see this decay all over our society. Go to happy hour at any bar. It is distinctly unhappy unless there is a unifying sports event on TV and people are largely scrolling through their phones. It's a really
picking your brain on this is interesting because I thought about this yesterday, driving back from a little staycation up north, and it was just funny because it was like the same conversation, like, oh my God, like, so we went to a new town, which uh, we've been to before, but hadn't been in years. And it's like, but it's the same as Scottsdale. It's the same as other towns. Like, in other words, you get the same restaurants, you get the same retail, you got the same, like, it's all pretty, it's all nice, and then it's not. And, like, you're driving through a graffiti barren area, and then you're in a mall where, there's nothing but Anthropology and Pottery Barn. And it's like, okay, cool. It's nice, feels good, but boy, this sucks. Like, it just, and I think a lot of us are feeling that. I think the interesting thing is this push pull of, like, where you're invested, what's growing, right, is those winners. Like, it's the power law. So that S&P mix, like you're talking about, and so you're not incentivized to invest differently, especially passively. Like, if you're just allocating through an advisor or whatever, and they're putting into a model portfolio, like, everything's kind of working, quote unquote, but it's delivering a very inhuman, unlocal experience. And now we're all kind of struggling with that because we live in physical reality. Like, we may view our lives online, but we actually physically live somewhere in a neighborhood, and we go get our gas at a place. Like, there's certain things that atoms still matter. And I think it's this interesting collision between our wants and needs for a more human experience will only continue to compound because AI is going to create noise levels that we can't even imagine beyond the ones that already exist on that algo driven world. So we're going to look to escape it, but we can't because our retirements and our dollars are also invested in it. And I'm
Yep.
wondering how that reconciles. Like, I'm wondering how, that's the thing I think about. I hope for it too, but I also don't worry about it because I see it as inevitable. Like, human beings have been doing human things for 10,000 years, and we crave experiences. We're meaning making machines. Like, if we can't make meaning out of something that's enjoyable, we're miserable. It doesn't matter how many commas are in our net worth. And so at some point those two things must collide. And I feel like they are. I'm not sure how it shakes out. And I don't know what that means in markets. I know that you could be early and wrong and lose a lot of money betting on it's going to happen sooner rather than later. But I do think it happens in our lifetime.
Yeah. I mean, I think that's true. I also would suggest that part of the problem is that for most human beings, certainly for myself, um, again, capitalism harnesses our individual wants, and the pursuit of that self interest is a remarkably powerful tool for society at large, as well as for personal advancement. But until you encounter something that is more important than that, and for me, that was the birth of my children, recognizing that there was an entity that offered me very little economic reward that I found myself ridiculously attached to for
Yep.
various, for various hormonal or logical reasons, created conditions where I became a different person. Right? In many ways, you say a man, and there's a part of me that's still perennially a 7-year-old boy, and there's a part of me that also is very much a 56-year-old man who spends most of his time worrying about how his children are going to navigate a world that is increasingly complex and disassociated from many of the components that have allowed us to define meaning historically. My hunch is we'll find our way through this, but we're going to fumble our way through it, just like we fumbled our way through industrialization, just like we fumbled our way through electrification, just like we fumbled our way through education systems that began, largely to effectively create, elements of a common narrative and control that reduce people's thinking of themselves as Italians or Scottish or Jewish or whatever, and instead focus them on the idea of the myth of America, which we then largely spent the last 50 to 60 years, with a group of true midwits. I would actually argue lower midwits in the intellectual space, arguing that no, those are all untrue. It's like, of course they're untrue. Every story has elements of untruth to it, right? The question is it a story that ultimately inspires people and draws them closer together? Is it a story that drives them to friction and to war? And we've turned our educational system into one that largely breeds an incredible ability of nihilism, or an incredible degree of an incredible number of nihilists who basically say none of it matters. And I think that's an incredible loss. I really, truly do. Um, but at the same time, we have to navigate through this. We have to figure out a way to the other side. And I think AI and other tools will eventually help us get there, but they could also turn out to be prisons. And
Well, that, without a question,
religion is an example of that.
Yeah, and I think I see Doug's comment in there too. I'll just kind of paraphrase it, but I think yeah, the fumbling through is us being head faked, sometimes by our own volition, sometimes by no fault of our own. Social was a good example of that. A lot of people didn't realize like the cancer that it was, and now it's kind of a habit, right? It's embedded, and it's like something we have to force ourselves to break. The reality is that a donut's really great, but it sucks for dinner every night of the week, but they're
Every
tempting.
night of the week, I agree with. On occasion,
You
a
know,
donut for dinner probably tastes pretty damn good.
yeah, yeah.
I
There's a time and a place.
I
Yeah,
remember what my kids used to enjoy every once in a while when we'd have breakfast for dinner at nights.
yeah, and
Listen, I see Doug's question, and I just have to point out to Doug that he misunderstands evolution. What you actually crave is dopamine. Your brain is wired to accept it and enjoy it. It is creating a signal to your brain that says, I am uniquely experiencing something enjoyable. It was created from an evolutionary standpoint to get you to do everything to respond positively to social encouragement, to raise your children, to enjoy entertainment so that you're brought together in social environments, which is a greater protection mechanism. You don't actually crave going to Bali, right? You crave being able to tell the story about Bali. You crave the momentary rush of recognizing that you actually are seeing something unique and then you can tell a story about it. You're not thinking about whether it's on a 100-inch digital TV or a 32-inch digital TV. And candidly, before we had 100-inch TVs, nobody knew what the hell you were talking about. So how did you crave it, right? What you craved was the dopamine.
yeah, and I think that's the thing is that we live in a world where we've created exponentially more sources of cheap dopamine, as all the
Mhm.
stuff we write about. And so that discernment becomes harder because again, dopamine feels good. So dopamine is dopamine. It feels good, but it doesn't last as long and the high doesn't last as long. And then, we become desensitized at a level where like luxury used to mean something. Now it's like a laughable word, right? Affordable luxury is like military intelligence. It's kind of like the ultimate oxymoron, right? It's kind of, it doesn't make any sense. And and ultimately differentiation is what is unique about human beings. I think the social need for acceptance and love, as those six human needs are, is very, very real and a very, very strong pull. And at the same time, growth and contribution are the higher order functions. And um we'll see what happens. But having young children myself, I think I loved how you said that. It's like this economic non-return that I care more about than anything else, that I give more of my time and energy and money to and more of my thought to than anything else. Like it changes the way that you perceive things. It also, I think, gives you hope for the future because like when I have a teenager and then I have two toddler twins that took us a long time to get. And when I watch them orient to the world, you kind of go, well, if we just don't mess that up, then everything's going to be fine because they're very present. They're very social. They're very, when you watch a child and you just kind of see them and you realize what you can program into that or not, you recognize that, hey, if we don't screw this up, like if we don't put too many layers on top of them and viruses on top of their their software before they're 5 or 6, then in aggregate, we'll have a very bright human future inside of this abundant intelligence. Um, it's an interesting time to be alive. There's never been a time I don't think to be alive.
Yeah, I mean, again, all of these tools can be manipulated. So, like you correctly highlighted that much of our electronic media is largely built around dopamine farming and engagement and providing people with that hit because it creates addiction. It's the same phenomenon as cocaine.
Yep.
And just responded to Doug online, he was asking various questions saying, hey, I know why we do these things, but why do we do these things, et cetera? And my point was, you just want to be recognized for the dopamine hit, right? Like what you're actually doing is the same reason why people originally post on Twitter or speak out in the comments on YouTube, et cetera. They want to be seen.
Yeah.
We as human beings desperately want to be seen. That's part of the reason why the Democratic Party fell on such hard times when Hillary Rodham Clinton announces that people are deplorable. Well, geez, nobody wants to be recognized for being deplorable. They want to be recognized as being unique and qualified and capable and valuable. They don't want to be viewed as deplorable. And that is a disgusting message. And
Right.
it's something, imagine you said to your kid, you're terrible, you're deplorable, you're a horrible human being, right? And parents do say that to their kids, and they are awful parents, and they are experiencing individual pain that requires them to express that to somebody who can't fight back in a legitimate manner. And that's a really terrible thing to do, but it is understandable,
Yeah.
right? And we build machines that harvest that dopamine, and we decide that we ultimately want to allow our society to engage in that. It's no different than opioid addiction in the 19th century. That's exactly, by the way, what opioids do is they prevent the uptake of dopamine and create conditions under which your body experiences the euphoria of the continuous presence of that in your system. Um,
It's
that
similar in prediction markets or in Robinhood, right? We've created
Gambling is the ultimate example of this. It is the exact same thing as when you open up an oyster and discover that there's food inside, right? Your body is designed to actually drive that curiosity so that you experience that joy when it's there. And you're like, oh my gosh, this is fantastic. And by the way, if it has a pearl, that's even better, right? Super fantastic. Now I'm going to be searching oysters endlessly, right? That's what monkeys and primates and humans and dolphins and all mammals do in one form or another. The evolved mammalian brain is largely a dopamine factory. And I'm overstating the case. If anybody's a biologist out there, I'm sure they know that. But the point is that we have now actually allowed ourselves to build the equivalent of the opioids from the 19th century into the machines that we carry with us on a daily basis. And that is largely driving us to lose the interaction that causes that dopamine naturally under social conditions. And
Yeah.
that is causing us to fracture. Now, we decided to ban the availability of opioids for exactly that addictive behavior reason in the 19th century and early 20th century. And we've tried to manage against that. And then all of a sudden we got it in our bright heads that, who is society to judge whether you should be addicted to to opioids, I'm sorry, what a judgmental behavior. What a terrible idea. Well, have I introduced you to excommunication? That's a real judgment call, right? So the idea that like we're going to frown on homeless people injecting themselves and stooping over because they're addicted to fentanyl in various parts of our inner cities, like we shouldn't be thinking about this at all as judgmental behavior. It's just common sense.
Right.
So, and by the way, the exact same
You
thing
have
is
to.
somebody who releases electronic media or electronic tools that allow my child to become addicted to it, just as the Delano family, as in Franklin Delano Roosevelt, sold opioids throughout the world and largely participated in the Chinese opioid trade to create their wealth that ultimately allowed them to emerge as the social evangelists for the 20th century. We all have hypocrisy in our background. We all tell better stories than we actually live in many ways, right? But that's a feature of a social society. We
Yeah.
have to accept that.
Yeah, and I think that's a key point. I think if we can accept that, we can look at it from this, that simple judge not yet lest you be judged first, right?
Great line, great message.
Yeah, it's just it's the humility to recognize that most of us, especially if we're listening to something like this, most of us are out there trying to do our best, whatever that means, right? And at the same time, all of us are horribly flawed. I know I am, right? And so we're going to do our best, and we're going to make a bunch of mistakes, right? And we're also going to hurt people along the way, and we're going to make stupid comments along the way, and we're going to do that to sometimes people we care a lot about. At the end of the day, if we can admit that, then we can recognize, the humanity in everyone, and that's something a machine maybe at some point can do. Maybe we can teach it to do that, but right now a machine doesn't do that. And so I think as we move into what everybody calls the second machine age, I think it's actually an interesting time to be more human than ever. And I think not just because I'm a hopeful optimist. I mean, I'm a pragmatist mostly, but I just understand gravity and like you just can't go one direction so hard and heavy and not have some retracement, right? And I think we've gotten as inhuman as we possibly could be. Maybe it'll get a little bit more, but we're pretty close. And now we're all connected. And so now as we kind of maybe rehumanize ourselves, then there'll be some good outcomes from that. That's what I'm kind of betting on. I think investment wise, it's interesting. So who do you think triggers the fumbling? I mean, you've defended the Fed in some cases. You think they get blamed a lot for too many things. Besson, give us a scorecard. Like where do you think we are in the regulatory environment of monetary and fiscal, policies, creating some level of progress or risk that is systemic at this point, one way or the other, like systemic good or systemic bad, or just like, like, are we stagnant?
Um, I, it, I'm going to pass on that question. There's
All right.
too many individuals involved that I know that do not need to be judged in that manner.
Very fair. That's fair. We just talked about judgment. So, um, if you if there is another angle to take at it, what I'm looking for is just a sense of how much are we giving it too much weight, and if so, why? Like, are we giving any of those things too much weight, or is it inherently something that we should care about? Because I feel like everybody worries about, oh, the Fed meeting is here, or what's happening in interest rates, and everybody's always got an opinion on that. When you think about it through that lens of just kind of it is what it is there is there another way to look at it? Is there another way to just look at the flows and understand there's a play somewhere no matter what? And how would I position for it? You could take that same look at political party too. Like,
Yeah.
who's in charge?
I, I I think the way that I would frame this is in the context of entropy or accumulated baggage that builds up in a system. We tell ourselves lies that accumulate so much weight that um, declaring them as lies often proves far more traumatic than the pain that we experience as we continue to do them.
Uh-huh.
Requires a cathartic break for that to change. And so that's what a revolution is, right? It's ultimately people responding to that which is no longer tolerable that they have tolerated.
The pain of holding on to it becomes far greater than the pain of just admitting it exists. That you get to that step one in recovery, basically, right? Where for those familiar with recovery work, right? You get to where you're just no longer in denial. And that doesn't
Right.
mean it's easy. It just means you're free from this baggage of that entropy. I like that.
Well, the irony is just like recovery, that's where the hard work actually starts, right? Because you realize that you've built an entire life around a lie, right? If you're addicted to drugs, if you are an alcoholic, you build coping mechanisms that paper over the underlying problem until that underlying problem becomes so overwhelming that the coping mechanisms no longer work. The United States and most developed economies have exactly that approach. We have a fundamentally flawed view of how the world works. We overweight monetary policy. We pay far too much attention to what the Federal Reserve does. We radically underweight the importance of how we spend our fiscal collections and distribute them, and to whom we distribute them, the standards under which we expect them to be held, etc. So we have a flawed methodology where we convince ourselves it's okay if Twitter suppresses or X suppresses speech or behaves in certain manners, or Elon says XYZ that is untrue because, hey, do your own research, sort of stuff, and fail to recognize the caustic elements of that and how it degrades our social interactions and ultimately our coherence as a society, and simultaneously destroys a counterfactual world in which we did not do that. Right? That parent who raises a child and tells them they're a terrible human being, um, doesn't have the counterfactual in which they treated that child with love and respect and facilitated their growth. And so when they look at them and they say, well, they're a nasty child and they're never going to amount to anything, right? Well, congratulations, you made that the case.
Mhm.
I don't believe that that's true of any child or any human being. I don't think anyone is irredeemable. And I don't think the society is inherently flawed in some way, shape, or form. But we're basically a society that continues to tell ourselves lies, right? If the high priests meet, there's 12 of them, they vote, they determine the price of money, and all is good. Occasionally the rain will come, facilitated by that. If they do a good job, we celebrate them. If they do a bad job, they don't. That's just not what is actually happening, right? These are broadly building in constraints that inhibit the behaviors of other members of our society and prevent them from taking actions or facilitate radical behaviors from some people, whether that's extraordinarily levered exposures that give people that expose our broader society to risk. If we don't have the mechanism for identifying it and judging it, then we ultimately have no capacity to properly regulate it. And I think that's my problem with most regulatory frameworks, is that they largely exist at this point to respond to what lobbyists are pursuing in their own self-interests and failing to consider, is there a principled approach to this? One of the cathartic elements of the Great Depression was that it actually cleared the path in many ways and destroyed people's allegiance to the idea that if you're rich, you really know something, right? It's a famous line from Fiddler on the Roof. And I think it broadly applies to all of us, whether it's me, as somebody who is better off than most people, or whether it's a billionaire who makes prognostications on, XYZ platform, and people assume, gosh, he really must know what he's talking about because look how successful he is. It's just an extension of Dunning-Kruger in another framework. Um, and so we need to be very aware of that, right? Your individual experience needs to be appreciated. And if there's one thing that I tend to find super interesting, it's when 9 out of 10 people are saying this isn't working. And the other, the expert is saying, gosh, this system works so well. If those people just understood it, right? That tends to tell me that the expert has no clue what they're talking about and is basically obsessed with their model. Emmanuel Dern's famous book, Models Behaving Badly, is a perfect example of that. And the work that I've shared broadly of Ole Peters on ergodicity, and the misunderstanding in economics and what's called dynamic stochastic general equilibrium models.
You said that, not me.
Economics is trapped in a flawed model, ironically tied to the work of John Hicks, who himself, said this is all wrong. I completely got Keynes wrong. The way we were all taught Keynes was completely wrong. It was a highly dynamic system in which it was unknowable what the individual objectives were. And we largely are looking for mechanisms that facilitate that as compared to the alternative. But you know what? In the world of Twitter and the internet and everything else, everybody finds a reinforcing population that says, dude, you totally got it. You nailed this. You know this better than anyone else. And anyone saying anything else, man, they are just stupid.
It's not even that they find it anymore. It finds us now. So that's the other thing.
Algorithm is designed to actually draw your engagement, and nothing draws engagement more than saying, Chris, you are so handsome.
Right. Well, even the AIs are doing that, right? I mean, OpenAI is guilty of it, right? Like you have to tell it to challenge you. Like otherwise it just goes, that's a great idea. It's like, I just said the sky was purple and whatever. And it's like, yeah, good idea. That's really insightful. It's like, no, it's not. Stop feeding me cheap dopamine,
Bingo. And actually, I would argue that may well be one of the defining elements of the AI era is that it's actually exposing us to that. When it's coming from an AI, it feels uncanny valley like false enough that we're able to recognize it. When it comes from sycophants on Twitter, it feels very different because other human beings that are validating us.
Yeah, and it does it has its own risks inherent in it too, which is that you have to be thinking that is that right? Because otherwise you could just get the cheap hit, right? But yeah, I mean, if you ask it stuff, especially when you ask it questions that you aren't an expert in, like when you really challenge it and you use it the way you should, like where you try and learn something new and maybe even write or research about it. But if you don't ask it questions like, where am I wrong or where am I missing something in this argument or what piece would I add that would make this, more defensible? If you don't ask it that, then it will just tell you what you want. Right. And, but then it does become more obvious. So it is exposing it, I think, hopefully more into the consciousness that we're all just, dopamine fiends.
Right. So let me do this. I want to hit on a couple of the questions.
Yeah, let's hit on some questions.
As I said, I am running short on time. So JC Corrigan asked, did your son go surface subs or aviation? He's referring to my son who just graduated from the U.S. Naval Academy. He is going subs. What could trigger a passive investing crash from Tony Rehan? The quick answer is you're basically asking me how many ways could I die in the ocean, right? Shark attack, drowning, etc. There's a number of things, but the most obvious one is simply that outflows exceed inflows. And so if you think about the mechanics of passive, there are various steps in that process, right? You send money to me as a fund manager, I'm going to amplify the funds that you're sending in terms of the market cap impact. I've done this analysis, shared it. It's actually interestingly just been validated indirectly by the work of Hannah Unterberg. If you send $1 to an active manager in general, that has a $2 multiplier effect in stock markets. By the way, the efficient market hypothesis assumes that it has a 1 penny impact, and the actual number, by the way, on my work is 1.83, which is overly precise to be very, very clear. If you send that money to a passive mutual fund manager, my estimate at the current point is that it, and historically is that it's about 7 times more impactful to send it to a passive fund because they will buy the largest stocks and therefore actually have a magnified impact on aggregate market cap because of the relative inelasticity of those stocks and irreplaceability of those stocks. You send it to a passive ETF, because a passive ETF no longer has the netting function at the end of the day. If you're a customer in a mutual fund and I'm a customer in the mutual fund, and I buy and you sell the equal amounts, no trading activity occurs because it's netted at the end of the day in what's called the market on close imbalance. And overall, those transactions are happening within the mutual fund complex to minimize trading costs. If that happens within ETFs, you place your order at 10:45 and I place mine at 3 o'clock, they can't net. So they have to be pushed into a smaller time period. That actually has a multiplier effect on my estimate of about 3, which takes us to my estimate of the impact of the vast majority of passive flows at this point coming through passive ETFs at about 22 times versus that give or take 2 times for an active manager. Historically, for the largest stocks, I now think that it's approaching 100 times multiplier. In other words, $1 into an NVIDIA is creating $100 worth of market capitalization. When you consider the fraction of those shares that are allocated to insiders, it explains why the employees at NVIDIA are getting so rich while you don't feel that way. Don't worry about it. They also feel like they're poor because they see their friends and neighbors getting even richer. Okay.
Well,
All right.
on that fact, though, the levered ETF side, the risks.
The levered ETFs then actually have a larger multiplier too, because they are basically doubling the order size in the same amount of time. And so technically that works out to about 1.7 times impact of even the traditional passive ETFs. And then you actually have the concepts of what I refer to as endogenous liquidity, because passive ETFs are levered and rebalance on a daily basis. If they appreciate significantly, they've reduced their exposed leverage because you gained equity within the fund that requires you to buy additional shares, even in the absence of flows. And so all of these things create feedback loops. It does feel like we are reaching elements of the penultimate episode in which we are now saying, well, not only ETFs, but levered ETFs, and not only levered ETFs on indices, which have diversification characteristics, we're going to direct them to single stocks. As I said, I'm doing an analysis in the semiconductor space right now, and every single stock in the SOX index has had somebody release a levered ETF with the exception of 3 names, right? And I'm sure those are coming. It's absolutely absurd.
Some
Like
some are 3-to-1, 4-to-1 I've seen, right? I don't know the exact number, but
on single stocks, it tends to be 2-to-1, but on some of the semiconductor ETFs, it is indeed 3-to-1, and that is a larger impact. It's just, look, it's caused the Korean stock market to become largely dysfunctional. It's had 8 shuts on a year-to-date basis versus 2 in its entire history. They're in the process of banning levered ETFs. My hunch is America, as Churchill said, will eventually do the right thing after we've exhausted all of the possibilities in the vast majority of individuals' portfolios. Let's see.
How do you hedge against that simply if you're just the practical
That's
grandma?
actually that is exactly the point of a systemic risk. It cannot be hedged. On an individual basis, you may place a bet that allows you to profit in those environments, but as a society, you cannot hedge against systemic risks.
Right.
You can choose to head them off at the path, but weak men make hard times, hard men make good times. We are filled with weak men at this point. I would consider myself to be part of that. Okay, why is passive not a rising tide that lifts all boats phenomenon? I think he means boats. Why does it only benefit the biggest stocks? The quick answer is because liquidity does not scale with market capitalization. Liquidity is a function of the dollar value that is traded. If you look at the dollar value trading on Apple versus the dollar value trading on Delta, there's give or take a 5 to 10 Delta Airlines, to be clear. There's give or take a 5 to 10x differential between those, while there is a 100x differential in terms of market capitalization. So when an order comes into a passive vehicle, it is buying in proportion to the market capitalization. That means that the order size is far larger for Apple than it is relative to its liquidity than it is for Delta Airlines. Likewise, substitutability. If I want to buy Delta Airlines, could I buy United Airlines? Yeah. If I'm really thinking about the macroeconomic components in terms of airline exposure, I don't care. And by the way, at 0.2% of the index or 0.02% of the index, so it has actually no impact on my portfolio, I can largely dispense with it. I can't ignore NVIDIA. I can't ignore Apple. I can't ignore Microsoft. And as a result, I must transact if I'm engaged in index replication on those names. We'll simplify full line packaging combination.
You don't take breaths. I love it.
We will figure out various ways around this. Doug, we have to disagree. I agree. We will disagree. And Steve Rogers says, what's the point of it? Herding behavior? No, the point of it is to reproduce. And you can recognize that as a beautiful thing, and you can recognize it as a deeply nihilistic component. I prefer to think of it as the former. So let's wrap it up there.
Yeah, I think it was a great one. So, Michael, I appreciate the chance to kind of have maybe one and only conversation I'll have with you, maybe more, but I never take it for granted. It's been stimulating, and thanks for everybody who's tuned in live. For those listening on replay, you've gotten a lot of value out of this. So please do us a favor if you have not subscribed to Michael on Substack or anywhere else where he may be there, give him some dopamine, give the algo some dopamine, and thank him for that upgrade. That's always nice. You get the full unlock. And if you're new to me, I'm happy to have you here. And it's been a pleasure to host this Atomic Level with Michael Green. I want to thank Pebble, who is one of our subscribers and who helps you hire people in 185 countries. If you want to check them out, highpebble.ai. You can tell them Wealth Matters sent you and get a better deal than I pay, because I love them and use them for years as my employer of record. So with that, we'll wrap it up. Michael, I'll give you the final word. I want to thank you again. I look forward to Simplify. When should we be paying attention to some of these announcements? You got a lot of cool stuff coming. What's the time horizon?
Listen, births occur in 9 months, in the physical form. In the mental form, they come when they come. So I anticipate some announcements relatively soon, but I appreciate the interest. And I just want to emphasize, what Bill and Ted, be decent to one another. Party on, dudes.
I really appreciate it. And I love that we connected on some of these elements of recovery and also just non-judgment. And again, super, super great to have you on the show. And I love that. Be decent. And Michael, thanks for being decent with all of us. Appreciate you.
Take care.
See ya.